If anything, you've said that experience has taught you can continue to learn. And at a time when so many young investors are getting into the market and everything is available to them at just a click of a mouse, do you think perhaps the element of risk has gone up manifold from the time when you were selecting stocks, you were looking for those gems in the market?
See, risk is a four-letter word and it's an adjective. So it means different things to different people, right? But remember one thing, risk, debt, markets, weather, we can all try to predict it, we cannot know it. Only the future will tell us what it is. So what is risk? But I know one thing, that risk is the essence of life. If you don't risk, you are nothing.
Okay.
Right? When I think there are few risk takers like me in life, right? But I'm a very measured risk taker. And in the sense that I can sacrifice my assets and sell them at below par value, but I should never let my financer have his hand over. My financer, I have to be here, my financer has to be. The day you put him here, you are risking. You know, on the day of COVID, you know, the index was 7,500. I sold 400 crores worth of shares in 2 days. I wanted 400 crores in the bank. So, you know, leverage has no mother, leverage has no father, leverage has no friends. Leverage is merciless. So I think when you take a risk, you should be conscious of it. And if things turn against you, you should be able to bear that loss without any damage emotionally or any substantial financial damage.
We humans believe that the greater the risk, the greater will be the rewards. Because of that presumption, equity investments are regarded as risky by their very nature, while fixed income instruments are considered safe. Stock market investments seem unpredictable because of the volatile nature of the market, whereas fixed income securities look safe due to their consistency. Their prices do not fluctuate like that of equity investments. Nevertheless, the influence of inflation makes fixed income instruments unsafe and insecure. It can erode your wealth. Conversely, equities, if managed efficiently, are a good shield against inflation. Hello and welcome to the Delight of Wisdom. I'm Bhavya Neeraj, and in today's episode, I will talk to you about the risk and rewards associated with equity investment. Equities as an asset class outperform fixed income instruments remarkably. I will show you some evidence. An investor would have made huge wealth if he had bought Sensex or Nifty in the 2000s and remained invested patiently for a long period. For instance, if one had bought shares of Asian Paints in 2000s for just 1 lakh rupees and stayed invested, today at around 3,100 rupees per share, one would have made immense wealth. That 1 lakh will be at least 3 crores. This is the advantage of equity investing and the power of compounding, which we already discussed. For those who haven't watched the episode of Compounding and its Significance yet, I am providing the link in the I button. Please watch it. It's crucial to understand the importance of compounding in wealth management. Now coming back to our topic. An investor would have made that humongous wealth only if he is intelligent enough to survive in the long run. How can an investor survive different cycles of the market? People are skeptical about stock market investment due to its wild fluctuations. Survival in the long run is the key to riches. We have already analyzed equity returns from the graph shop. It's impressive. If equity investments have done so well, why not all the investors? Why do people lose money in the stock market? Seems paradoxical, right? It is the behavioral peculiarities of the participant in particular, and the comprehensive crowd behavior makes stock market investing appear a risky proposition. Deciphering the stock market cycle is complicated because markets are made based on miscellaneous opinions expressed by their participants. One of the all-time great investors, Charlie Munger, says, "All I want to know is where I am going to die, so I will never go there." Before entering into stock market investing, one must be aware of what not to do what he has to do. Let's dig deep into the charts of Asian Paints through the eyes of an investor, Mr. X. The share value of Asian Paints in the 2000s is less than Rs 20. Consider this scenario of Mr. X buying 10,000 shares at Rs 10 per share. If he is conscious of what's happening in the world of Asian Paints, he can efficiently manage that money and harvest handsome returns. But if Mr. X has no idea about the business, he can't hold it for a long period. What happens to most people is, after losing patience, they end up mostly with negative returns. That is, some people enter during an uptrend, say Rs 120 per share, and exit during a downtrend. That is when the stock price is Rs 70. Sometimes for instant gratification, many people will sell the shares for poor returns. For example, buying at Rs 60 per share and selling at 100 rupees per share due to lack of knowledge and panic. So the most common blunders Mr. X can make in equity investment are selling winners too soon and holding on to losers, buying expensive stocks, getting anxious about seeing his investment showing poor returns in a short time, and buying when others are buying and selling because others are selling. But if Mr. X is an intelligent investor who follows the business regularly, who has a clear notion about what's happening in the world of Asian Paints, he will certainly make handsome returns. To gain that level of knowledge about the business, an investor must go through the annual report of the company, attend the conference calls, and must be aware of the sector and peers. Efficient decisions can be made only through clear insights. Self-awareness is the key to successful equity investing. The major risk associated with equity investment is our emotional flux. A precise perception of investor behavior is paramount in equity investing. So in the next segment of the episode, let's dive deep into the basic characteristics of us humans. An unmistakable understanding of those will have a profound impact on equity investing. First is laziness. We are mentally structured in such a way that we cannot consciously choose a more difficult way to accomplish something if we can choose an easier way. This is neither good nor bad. It is only what we do as an outcome of this laziness that is good or bad. The advancement of our species comes from people seeking faster and easier ways to get things. Thus, in certain sense, laziness is a motivator of our development. Next is greed. We each try to get the very most with the very least expenditure of money or effort. Given a choice between more or less, we strive to maximize what we get. That is rational, sensible, and appropriate human behavior. In this sense, we are all greedy. This is again neither good nor bad. We are greedy, we are never satisfied, and we are continuously striving for more and more. The third one is ambition. We are so powerful that no other species can stand in our way. All our actions are motivated by a desire for improvement in our condition. We cannot consciously act to worsen our situation. We are all ambitious. Another interesting trait of us is self-interest. We all primarily act from our perspectives. Everything we do, even acts of charity, we do because in our personal opinion, at that moment, it is the best thing for us. Selfishness and self-centeredness render us a sense of survival. Next is ignorance. No one is perfect in this world. Nobody can know everything there is to know about one subject. Progress is an endlessly iterative cycle. And lastly, vanity. We all have an ego. We consider ourselves superior to others in many ways. It's just human nature. Sectors like cosmetics, fashion, furnishing, etc. flourish because of this peculiarity of us. So we humans, basically lazy, greedy, ambitious, selfish, ignorant, vain, strive in varying intensities for the same necessities: security, comfort, leisure, love, respect and fulfillment. No wonder there is chaos in this world. Now we will see the sources of returns in the last segment of the episode. In contrast to fixed income securities like bonds or fixed deposits, in which interest income is the only source of returns, equity returns depend on two sources: fundamental and speculative. In fundamental source, the earnings behind the company along with the dividend paid out during the holding period are covered. In the speculative source, the changes in the assessment of the current performance and prospective profitability of the company are covered. This speculative element is the product of the general sentiment prevailing and the presence of greed and fear amongst the investors. This is subject to turbulence, and this is what makes the markets volatile and unpredictable, and of course intriguing. Let me bring clarity to this idea by elucidating the downfall of Intel Corporation's share price. For those who don't know, Intel is the world's largest semiconductor chip manufacturer by revenue. But this fundamentally dominant semiconductor giant has been dethroned from its position. It eroded the wealth of its shareholders. Manufacturing delays, failure to enter the mobile chips market, and losing market share in the PC and data center segment to competitors are the few reasons that led to the collapse of the company's share value. But if you are an intelligent investor who is aware of the business and has a thorough understanding of what's happening in the realm of semiconductor industry, you could have made enormous wealth by identifying the right counterpart at the right time. Now let's analyze how Advanced Micro Devices aka AMD strategically converted Intel's odds to its opportunity. In 2017, AMD introduced its highly successful Ryzen microprocessor architecture, which quickly surpassed Intel in sales as an affordable alternative to higher-end CPUs. AMD's share value is up more than fourfold since then. An intelligent investor identifies this eminent shift and could have reaped a great return by partnering with AMD. Before ending the episode, let me highlight the crux. The major risk associated with equity investment is our unawareness and emotional instability. If managed efficiently, we can reap huge rewards from equity investments. Invest only in businesses that you know. Hope you got a clear understanding of the risk and rewards associated with equity investments. Comment your opinions below. If you find this video informative, please subscribe. Thanks for your time. I will see you in the next episode.